Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita. Very quickly, Polycab's numbers flashing on the bottom of your screen. You can see those numbers, 13.9% in terms of margins. Generally, when you're looking at Q1, it's softer than Q4, and therefore that's probably the better way to look at the numbers. But strong growth, top line, EBITDA also growing 32%, PAT growing 32% on your screen, 784 crore. I'm also going to quickly pull out what was expected and try and give you a sense as to how the numbers have shaped up. But broadly, it's looking like a good set of numbers from Polycab. 1137 crore on the EBITDA number where Polycab is concerned, and 13.9% in terms of the margins versus 14.5% same time last year. Revenue growth has been strong, led by wires and cables, 38% growth in the wires and cable space. The expectation was that the top line will be in around the 7,755 crore number, so a clear beat on that one. Operating income also, or rather EBITDA also expected around 955 crore. It's come up above the 1100 crore number, so again strong there as well. And profitability also has come in above expectations. So very strong numbers. You can see a bit of a spike on the stock price as a result. Good set, but that's with regard to Polycab. I'll quickly shift focus to the market as a whole. 0.25%, well, we're flat at this point of time, 15 points in the green. It's actually IT which is driving the gains, 1% higher on IT, a third of a percent low on the Nifty Bank. We're also seeing some moves within the Nifty 50, and some of the movers of the morning at least, and HCL Tech continues to be the top gainer but has cooled off from the highs. Excuse me. We've also got Interglobe Aviation up nearly 2% as well. Maruti is up 1.5% as well. So those are some of your gainers. 1:1 on the advanced decline. And Interglobe Aviation, you can see on your screen, intraday has actually gained from strength to strength as the day has gone by. Top losers, SBI Life and Eternal. Swiggy, though, completely different story. That stock is trading in the green. In terms of sectors, and I'll quickly touch upon IT, 1% higher on the Nifty IT index, top gainer on among sectoral indices. Nifty Auto is up 0.5%, FMCG also up by around 0.5% thereabouts. The key drags are Realty and Finance, the Fin Nifty, and Defense. Those are three key drags, and Defense has been one of those losers since the start of the day, continues to be so. I'll also quickly look at how broader markets have shaped up. Some bit of pressure on both the Nifty mid-cap and small-cap indices, some outperformance shown by the Nifty 50 index versus some of those. In terms of buzzers and some of the top buzzers, ICICI Lombard is down 11% on the back of numbers. Signature Global, Nuvoco Vistas. Nuvoco, after the couple of days of very strong up moves, seeing a 5% correction on the stock price. Aegis Vopak, HDFC, AMC are just some of the other stocks which are under pressure in trade. In terms of the gainers, MRPL, again on the back of numbers. Himadri Specialty up 7%. Chennai Petro, ABB India 7% higher. Dixon Tech up 6%. MV up 6%. All of these were largely expected since the morning, except ABB, of course, which came somewhere midway through the day of trade. Let me take it across, though, to Avi. He has some of the stocks that are buzzing and why.
So let's discuss some of the stocks that are buzzing in trade today, starting off from MRPL, which is up around 8% on back of its Q1 FY27 earnings, as the PAT has surged on a quarterly basis and stands at around 964 crore rupees against a loss in Q1 of FY26. The revenue is also up by 120% on a yearly basis and 60% on a quarterly basis to 38,250 crore rupees, signaling strong execution. The EBITDA, although, has compressed 26% sequentially due to operational dynamics. Up next is MV Photovoltaics, which has also surged by around 6% on back of a very strong quarterly earnings. The PAT has more than doubled on a yearly basis, surging 102% to 380 crore rupees. The revenue also is up by around 51% on a yearly basis, signaling robust solar model execution. Our next pick would be Jana Small Finance Bank, who has come out with a very strong Q1 numbers with the NII, which is a net interest income, up by around 30%, 34% on a yearly basis, and the profit up 52%. And both the NNPA and GNPA, which is the net NPA and gross NPA, has declined on a sequential basis, which is a very strong indicator for banks. Up next is Mrs. Bector Foods, which is up by almost 12% on back of Abacus Investment Managers taking a 0.95 5% stake in the company at 168 rupees per share. Our last pick would be Jupiter Lifeline Hospital, which is also up by 4% as HDFC Mutual Fund purchased a 1.42% stake in the company for a deal size worth 139 crore rupees at 1483.5 rupees per share. And that is the reason these stocks are buzzing in trade.
Much for that, Avi. You can see some of those names bouncing around. Let me go across. In fact, we spoke with the management of ICICI Lombard after the weak Q1 numbers that they've delivered. Mr. Gopal Balachandran on what he believes were key underlying factors that put pressure on the numbers of Lombard.
We did have a couple of large losses in the fire segment. And that's the reason why we specifically put both of them in terms of the impact that it had on the combined ratios. On the judgment alone, I think at this point of time, basis the prudent and conservative estimate that we have put across, that had an impact on the combined of roughly about 2.8%. And the impact of the two large losses on the combined was roughly at about 1%. And when you kind of take this out, and as we keep saying that you have to keep looking at combined on an N basis, the combined ratios is pretty much in line with what we have been speaking even in the past, as in to say that Q1 of last year was at a combined of 102.2%, excluding a couple of these events, which also has kind of industry impacting elements. For us, the combined would have been 102.3%. We will work with the commercial corporates in general, and we have clearly seen huge positives play out in terms of the experience that we have seen subsequent to the value-added services initiative. And more importantly, given that we are also doing this particular service, the extent of customer retention in terms of the number of corporates who tend to kind of stay on with ICICI Lombard is a very high number. So it helps us on the dual front, and that is exactly what we will continue to exhibit even when we look at in the current context.
All right, so that's on Lombard. Of course, some of the other insurers as well. Let's try and pull out what some of them are doing. And ICICI Pru Life is seeing a bit of a cool off on that stock price, despite posting decent numbers, I must say. And HDFC Life, can we pull that one out as well? Try and see how that one has done through the day of trade. HDFC Life also just about 1/3% lower, despite a decent set of numbers. There was a spike at the start, but that spike has been sold into and sold into quite ferociously. Okay, so that's that. Let me invite Kashyap Javeri. He's from MK Investment Managers, joining us this afternoon to give us his view on the market. Kashyap, great having you. Let me first start off with what is it? How are you positioning yourself for a market like this? You know, you see IT down 2 days and up the third. How do you play a market like this at this point of time?
So, thank you so much for having me on the show.
Very good.
You know, we have been dealing with volatile markets now for almost about probably more than 24 months. Primarily, I would just like to draw attention to one data point. Probably the all-time high of Nifty 50 or Nifty 100 that we saw is now today almost about 650 days away, right? So we have been dealing with this volatility for quite some time. How we are dealing with it for our client portfolios, our approach always has been, bottom up. We usually look at the stock and then, probably where we are sector agnostic, we are market agnostic in the sense that we are quite flexible in terms of market cap as well as the sectors, and try to pick winners first and then probably look at what sector or what market cap they belong to. In fact, probably quite a meaningful proportion of our portfolios was tilted towards mid cap for almost about last 18 to 24 months. And despite whatever has happened in the market, that part of the portfolio has done reasonably well. So I think, we have been dealing with volatility. If we are going bottom up in terms of our research and stock picking, we will continue to take that volatility in our stride.
I'll just quickly mark out ITC Hotels, a very strong set of numbers at the outset, 180 crore, 35% growth on the bottom line. Even the margins have come in better on a YOY basis, 31% versus 30%. Revenue has gone up 15%. So operating efficiency playing out, but it's getting sold into quite sharply. Kashyap, I wonder, you're a bottom-up stock picker. ITC hotels, there's been, since the time it got demerged, there's been a lot of fluctuation on the stock price, right? It's fluctuated between 150 rupees and 250 rupees. There's been huge fluctuations. How do you look at this story more from a medium to long-term standpoint, right? Maybe you don't talk stock specific, but just give us the sense as to how would you look at a stock like this or the sector as a whole and the kind of story that's playing out within hospitality.
So I think I would probably, rather than just looking at hospitality, I would probably comment on the whole discretionary spend as such. And I think most of the numbers that we have looked at in probably first half of this calendar year, whether we look at the payment indicators like UPI payment indicator growth, or we look at the generally electronic payments growth. If we look at the same store sales growth for a lot of these value retailers, as well as probably high-end retailers like Phoenix, as well as I would also point out to the fact that if you look at generally the box office collections, where ticket prices I would assume are slightly middle to upper middle class kind of consumption item, they have seen a fairly strong growth in the H1 of this calendar year. We do expect that discretionary growth or growth in the discretionary spending ideally should continue in slightly medium term future also, and in that sense we are quite bullish on discretionary spend items across the board, and that's how our portfolios are also today aligned.
Okay, and Kashyap, you typically suggest that you have to start buying chaos, right? Because that's where the value really lies, and therefore, would IT be a buy at this point of time? Would you buy that kind of chaos, or is it just too much chaos in that particular pocket?
So I think the way we are looking at IT today is that the value has the derating both in terms of time as well as overall valuations has created significantly deep valuation cuts out there. Generally, if you look at probably even some of the ETFs within that space, I think dividend yields could be in sort of a fairly good single digit number. So yes, we do see a value there in terms of sector. Having said that, our broader view is that overall earnings, probably even if there is no threat coming from AI or probably any other kind of broad macro threat to that particular sector, overall earnings growth could be constrained to probably a low double digit, not probably even 10 digit, but I would say a low double digit kind of growth number. India is a growth market, right? People seek growth when they look at India. And in that sense, while there might be probably initial some bit of up move because of the deep value that's been created, I think if you're looking at a fairly long-term value creation, I think plenty lies in many of the other sectors available on the exchanges.
Don't touch IT at this point. Kashyap, I wonder whether mid-tier IT stocks, which are actually growing. I mean, it could be mid-teens growth, trading at 35 times odd. But would those interest you at all, or would you stay away from that pack as well?
So I think at this point of time, our portfolio weights are aligned in line. We are not overweight out there. It's largely in line, just marginal bit of overweight. But I think for the time being, we are quite happy with that, not going anywhere beyond where we are.
Point taken. Viewers, I'm going to have to take a pause on this conversation. It's very difficult to leave Kashyap without asking him his take on banking, by the way. He's traditionally a BFSI analyst. So tough to let him go without asking him banking. We'll quiz him on that on the other side. Stay with us. Welcome back. We're in conversation with Kashyap Javeri of MK Investment Managers, and he was of the view just prior to this break, you stay away from IT at this point of time due to lack of growth. On the mid-cap side of things, neutral, because there is some bit of growth. Kashyap, talking about, therefore, sectors where there is value, right? I mean, how should one look at banks, therefore? Some of these banks were trading at 3-4 times book a couple of years back. Book values have compressed and valuations have compressed really substantially from that point. But when you compare them to some of the larger banks and, globally, they're still trading at a premium. I know it's not the right way to look at banks, especially in India, given that there is growth. But what's the right way to kind of rationalize that your PSU banks are trading at 1 time, and then you've got some of your private sector banks trading at 2 times, growth largely the same. ROAs are obviously slightly different. But growth, in fact, for private is slower than PSU in most cases for the last couple of years.
So I think let's dissect this into 2 parts. So you rightly said that if I look at global banks, obviously we are still at quite a premium. And having said that, but if you look at the dissection of the growths, while our banking as a space has been largely about banking and less about or rather commercial banking and probably less about everything else, I think it's not strictly apple to apple comparison out there. Between the PSU and private, I think if you look at broadly the growth drivers which impacted probably private banks until now was one. Obviously, there has been some bit of competition which came from the PSU banks in last about 3 years that PSU banks have been repairing their balance sheet, and consequently it gives them some bit of leeway to grow the balance sheet now. But a fairly large part of that earnings was also sort of driven by the fact that their legacy NPLs were sort of reducing. They have been completely provided for, which means your provision line items were reducing. And point number 2, if you look at the breakup of the return on asset, a fairly large part of that ROA also came from recoveries which happened from the totally written off account. I think both these earnings driver for PSU banks have faded considerably. Whereas if I look at the private sector banks, what's working in their favor is one, their market share in deposit is still rising, though not at the same magnitude as it has been in the past. Secondly, if you look at the margins where their book were largely linked to external benchmark, now that impact of reducing external benchmark is already in the margins. And point number 3, if you look at generally the credit growth in the bounce back now in the fourth quarter, what we are seeing is that the private sector banks have started growing marginally now faster than the PSU banks. If I look at overall valuations, obviously when I'm looking at 1.6, 1.8% ROA, which are core, versus 1% ROA for PSU banks, where almost about 20 or 30% of that ROA is actually driven by the recovery in the technically written off accounts, as well as some bit of provisioning, that saved because, the overall NPLs were not rising or either declining. I think it's going to change in favor of private sector banks as we go forward. So I think that valuation gap between the private and PSU banks, which has been still there, I think it needs to be, they're taking into account the fact that core earnings are materially different for both of them, much more pronounced for private and much less pronounced for PSU banks. I think we do believe that there is significant value now available in the private sector banks. That's where our money is also, lying in some of our strategies at this point of time. But our favor at this point of time would be more on the private sector banks, plus even NBFCs for that matter, versus, let's say, PSU banks.
Very clear, Kashyap. I'll talk about banks before I go to NBFCs. So, again, on the private sector banking side, would it be the larger ones? Would it be the smaller ones with faster growth? Given that there's asset quality improving, at least in terms of a trend. We were speaking to Jana today, and they were also suggesting that if 45 bips is our credit cost quarterly, of course, in the current quarter, then you can imagine what our full year credit cost will be. And this is the worst quarter technically for someone like a Jana. And therefore, that was the kind of guidance that he has given us. Give us your sense. Where do you sit at?
So our decision making in case of BFSI, and this includes both banks as well as NBFCs, it starts from the start point of that is where particular bank or an NBFC is able to raise money at the cheapest price, and that's the starting point of any decision that we make in BFSI as a space as in totality. I think in that sense, we do believe that private sector banks, in particularly in large space, have been chasing away market share yet from many other peers, both including public as well as private. I think that's going to continue for at least, we would say, anywhere between medium to slightly long-term future. That's something that's going to continue to happen. So that's where our some of the strategies have quite a bit of exposure. We do also like some of the mid-cap banks, particularly where we have seen that some of these banks have been able to get away market share in deposits from the PSU banks within their respective geography. Because many of these mid-cap space are more geographical concentrated in their operations, but we have seen some of them doing quite a phenomenal work on the deposit side. So we have about a one or two names in the mid-cap, or let's say very old gen private sector banks also. So that's how our banking exposure has been. At this point of time, I think in terms of PSU banks, we do not have any any much exposure at this point of time.
Okay. And Kashyap, how should one look at the manufacturing space, given everything that came out in terms of the outcome from the cabinet meet yesterday? Do you believe that it changes things materially on ground? Because some stocks have really moved, but just your sense from a slightly more long-term kind of perspective?
So I think if you look at broadly the actions of the government since last about 5-6 years, they have been tilted more towards manufacturing space as such. I would actually compare this last 6 years with the period that we saw for banking between 98 to 2002. You had plethora of RBI regulations which came in. You had significant amount of IPOs which raised money for a lot of these PSU banks. In fact, even they had private placements which jacked up their the capital when they were in the miserable state. The overall change in the capital structure as well as the way these banks were functioning, we saw that whole bull rally in terms of BFSI between 2002 to 2008 or 2010. I think manufacturing is at that sweet space at this point of time where the focus of either the regulator or the the government or the manufacturers themselves is razor sharp on this particular sector as such. We have showcased that in terms of automobile and auto ancillary in last almost about 30 years. We have shown that in case of electronic electronic manufacturing services in last about 6 years. We are, probably I would say more than today in terms of B2C or D2C, or within that the whole chain of B2B2C. I think we would be more inclined towards B2B at this point of time rather than B2C. So I think manufacturing probably for next 10-20 years, I would see that anybody who is in the formalized economy, whose vision is fairly big and has ability to execute, I think that's where the most money will be made. I think as a corollary, what one can look at is that recent report by UNCTAD also tells us about how FDI is moving in this country, and versus a very meager or miserable share of FDI which used to go to manufacturing probably 5, 10, 20 years ago. Today the share of manufacturing is now probably neck to neck with services in terms of inward FDI. Yeah, so I think our inclination at this point of time on B2B is fairly high.
Thank you so much, Kashyap, for joining us and giving us that perspective this afternoon. We've had a very meaningful conversation. Thank you.
Thank you.
All right, plenty of takeaways from that. Let me go across to Meryl. She's here with some of the stocks you want to keep on your radar at this hour.
That's right. Here's some of the stocks that have seen buzzing in today's trade so far. Starting first with Sterling and Wilson Renewables, the company saw quite a muted set of first quarter numbers where revenues fallen 18% on a sequential basis. EBITDA has slumped down 46% quarter on quarter. EBITDA margins also seen a contraction, dropping to 4.9% from the previously recorded 7.5% in the last quarter. PAT as well for the company has dropped down 62% on a quarter-on-quarter basis, which is why the stock has been seen in such pressure lately. Himadri Specialty Chem is the next name on my list that actually has performed very well in this past quarter. They've recorded their best ever sales, EBITDA margins, EBITDA and PAT numbers. Consolidated on a year-on-year basis, revenue came up for the company about 28%. EBITDA also jumped up more than 30% for the company, and they've done a lot of strategic initiatives as well, which is why we're seeing such up moves on the stock. ITC Hotels, on the other hand, has reported a strong set of numbers as well. Consolidated profit for the company has gapped up 35.5%. Revenues are higher at about 15% as well. Newgen Software also on the back of their first quarter updates, where the company's US sales stood at a gap down. The US sales have performed lower than the previous quarter, almost 14% lower. India sales as well were down 23%. Profit for the company took a hit of 41% on a quarter-on-quarter basis, while overall revenues were also seen 20% lower. So these are some stocks that have seen buzzing in trade today on the back of their first quarter performance.
Thank you so much, Meryl. Welcome back, and we're joined by Arpit Beriwal of Motilal Oswal Financial Services. Arpit, great having you. Let me start off with the index move itself. Very muted today. How are you looking at the market, and what levels are you monitoring?
Very good afternoon to all. So if you see overall the headline indices, so if you see Nifty has been stuck in a range from last almost 4 to 5 weeks in a range between 23,800 on the downside, whereas on the upside 24,444, 24,500 levels. And within that, if we see interesting on daily chart, index is hovering between its 50 DMA and 200 DMA. So it's finding hurdle near its 50 DMA, but at the same time it's taking support near its 200 DMA. So Nifty has senses that overall Nifty is likely to be in a range between 23,800 to 24,444. And any decisive close about 24,450 will open the momentum towards 24,600, 24,800. Whereas on the downside, 23,800 is the major support zone. And till the time we sense that the stock specific action is likely to continue, and 23,800 is a major level to on closing basis. If it closes below that, then we can expect some weakness. But till that time, index likely to trade in this range. If we talk about Bank Nifty, so Bank Nifty also has got stuck in a range of 1,500 points from last couple of weeks. In fact, if I look at the weekly setup from last 4 weeks, then on the downside 57,000 is a support zone, whereas on the upside 58,250, 58,500 levels. So our sense is that the coming weekend we have a lot of almost majority of the private bank results, and from next week onwards you can see momentum in Bank Nifty. So overall Bank Nifty our view is mixed. On the downside 57,000 is a support zone, on the upside 58,250 is the hurdle levels to watch out for.
IT, Arpit? What about IT, Arpit?
So if you see IT index, as the results are already kicked in and few of the IT companies have already come up with the results. So now looking at the IT index, definitely if I see technique from the monthly perspective, we have seen some pullback from the lower levels, major support levels of almost 26,500. We have seen good recovery from the lowers on the monthly time frame. Having said that, if we see on the daily time frame, it is consolidating. And looking at the overall index wise, I think the major price wise correction has been already discounted and has been already done. But within the certain pockets are looking good, and if you see particularly mid-cap ITs, for example, if I look at the chart of Persistent, relatively Persistent looks good recovery from the lower levels. So overall, it's a mixed bag. Few counters outperforming, few counters underperforming. And if you see want to play on the bounce side move, so Persistent is the counter that we are looking out for. A good base formation.
Okay, we've got Arpit on a patchy line. Arpit, we'll just fix that line of yours, but we'll take your stock calls. But let me go across to Meryl. She's standing by with the electronic manufacturing stocks, because those are surging after the cabinet cleared 2 major incentive schemes worth nearly 1.9 lakh crore. Brokerages believe the biggest beneficiaries could include Dixon, Keynes, Cyan DLM, and Syrma SGS. Meryl here with the full picture.
That's right. For decades now, India has been known as the hub, the assembly hub for global electronics. But the government's next goal is about to be a lot bigger. It wants to send India into becoming a complete electronics and semiconductors manufacturing powerhouse, much like the likes of China, Taiwan, Korea, and Vietnam. And that's exactly what these 2 new schemes are trying to achieve here. The cabinet has approved a massive 1.27 lakh crore Semicon 2.0 program, along with a 62,500 crore mobile phone manufacturing scheme. Now, this marks one of India's biggest pushes yet towards electronic self-reliance. But let's start first with the mobile phone manufacturing scheme. Now, this is not the very first PLI scheme that the government has introduced. In fact, the previous one helped India become one of the world's largest smartphone manufacturers. But a large portion of the components are still imported from outside. This new scheme shifts the focus from simply make in India to make more of India. The companies involved will receive incentives ranging from 2.25% up to 5% on eligible phone sales, with additional rewards for local sourcing, backward integration, Indian brands, and even investments into product design and R&D. That means that the winners won't just be smartphone assembly companies, but there'll also be companies building a deeper smartphone manufacturing ecosystem. And that's why Dixon Tech is expected to be one of the biggest beneficiaries from this scheme, thanks to its strong backward integration capabilities and also its local sourcing capabilities. Amber Enterprises could also be a major beneficiary as it expands its electronic manufacturing business. But the second and the arguably bigger scheme is Semicon 2.0. Today, India designs chips, but manufactures very few of them. The government now wants India to be an entire semiconductor value chain, from chip design and specialty materials to fabs, packaging, testing, and advanced R&D, all under one roof. It's a strategic move which is aimed at reducing import dependency while also positioning India as a credible global semiconductor destination. This is going to be bringing companies such as Kaynes Tech, Cyan DLM, Surma SGS, Tata Elxsi, and Moschip Technologies into focus, while CG Power, Tata Electronics, and Kaynes could benefit from investments in fabs and advanced packaging infrastructure. Now, we've also got some brokerage views on these policy. Brokerage Motilal Oswal believes that the impact will extend far beyond electronics manufacturing, creating opportunities throughout the entire supply chain of the semiconductor space. Its top picks include Dixon Tech, Cyan DLM, and Surma SGS. But the bigger takeaway from this is that India is no longer just chasing higher smartphone production. In fact, we're trying to build the entire ecosystem right here at home. And if executed well, these schemes could become the next major growth driver for Indian manufacturing as a whole.
All right. Thank you for that, Meryl. That's comprehensive. Let me go across. Kaynes Tech is one of the managements we spoke with, soaring on the back of Semicon 2.0. We spoke with Mr. Muthukumar Narayanaswamy, who's the managing director of Kaynes Technologies. He believes that India will touch 10 to 15% of global semicon market share by 2035. Listen in.
Coming and launching the Semicon 2.0 as committed earlier. This is definitely going to give a big boost for the industries. If you look at India, the semiconductor opportunity of India is substantial. The India semiconductor market is expected to exceed more than 100 billion by 2030, driven by the rapid growth in automotive, electronics, industrial automation, and AI infrastructure, telecom, consumer electronics, and data centers. Today, however, the country continues to depend heavily on import for a majority of its semiconductor requirements. The additional capital support is important because of semiconductor manufacturing is one of the world's most capital-intensive industries. Beyond water fabrication, success depends on developing the broader ecosystems, advanced packaging, OSAT, substrate, materials, PCBs, testing, and electronic components. In a short term, we expect the policy to accelerate the fresh investments, improve project viability, and attract greater participation from both global and domestic companies. It should also encourage faster localization of critical components, strengthen supply chain resilience, and create high-value content.
Okay. Arpit, any of these companies from within the EMS basket standing out? We've seen a very decent rally from the lows, by the way, especially in something like a Dixon, where the stock is up now, I believe, 40 or 50% from the lows. What's the sense?
If we see overall, the broader market is outperforming, and if we see a very stock-specific, theme-specific action is going really well. And if I look at the chart of Dixon, if I just pull out the monthly chart, so stock went vertical rally from 6,000 to 18,000, and post that we have seen a corrective move towards 10,000 levels. But if we see the beauty of the chart, a very strong recovery on the monthly time frame. We have seen good recovery from the lower levels for almost 11,000 to 14,000 levels, but the bigger trend is positive. So our sense is that definitely we can see overall good momentum towards 15,000, 16,000 plus levels. So the bigger trend is positive. Overall, kind of a buy and dip counter from a positional perspective. Along with that, one more counter that looks within the similar space is Sirma SGS. So if we see very strong setup was seen on the monthly time frame, though we have seen a very good rally from 900 to 1400 levels, but in spite of that rally from last 4 weeks, the stock is holding at life high territory. That clearly indicates the relative strength is quite strong. Trading away short-term moving averages, and the next level to watch out for is around 1550, 1600 plus levels. So Sirma and Dixon still looks promising on charts from a positional perspective.
Right. Okay. What we'll do is slip into a very short break. Arpit, hold on. We'll come back straight to you on the other side. Stay with us. Welcome back, and we still have Arpit with us, but before I go to him, the government has released the draft corporate average fuel economy or CAFE 3 norms for stakeholder consultation, laying out the next phase of fuel efficiency standards for passenger vehicles in India. My colleague Prakash here with all of the details.
Well, the Power Ministry has circulated the draft corporate average fuel economy 2027 norms for stakeholder consultation. In fact, the norms are proposed to be applicable to M1 category passenger vehicles manufactured or imported for sale in India during financial year 2028 to financial year 2032. In fact, the ministry has sought suggestion and feedback from stakeholder and general public within the next 14 days. The draft proposes a credit debit mechanism under which companies that outperform the prescribed targets will earn credit, whereas those falling short will incur debits. In fact, vehicle manufacturers will also be allowed to trade credits among themselves. Companies will have the option to meet compliance requirements by purchasing credits from the Bureau of Energy Efficiency. The draft further said credits generated during the compliance period from financial year 2023 to financial year 2027 can be carried forward up to 5 years. In fact, debits can be adjusted through credit trading or credit buyout until September 30, 2027. Non-compliance with the norms will attract penalties and other action under the Energy Conservation Fund. In fact, the amount received from buyout of credits for compliance shall be credited to the Central Energy Conservation Fund.
Okay. Arpit, from within the power sector, anything that's standing out to you? How do you play power as a theme?
If we see overall, the power space has been in action. If we see a couple of counters such as Tata Power, JSW Energy, though they have been sideways. So few days there is some pullback move and post that there is consolidation. So if I look at the setup of Tata Power particularly, so if I look at the monthly setup, definitely the stock was seen a good rally from 350 to almost 450 levels. Post that the stock has gone into a corrective phase and forming lower structure. So if we see overall the sector is in a sideways consolidation, and so far there's no major momentum has been picked up in overall the space so far. So I think within that, if we see particular counters such as Adani Power, so if we see Adani Power is relatively outperforming within the entire power space and holding well at its life high territory. So our sense is that once the momentum picks up, Adani Power is likely to lead from here. So monthly setup is strong. On the weekly scale, is this forming lower highs but holding well above its 50 DEMA. So I think Adani Power would be a good buy if it corrects towards 205 to 110 levels, with major support around 190 for an upside move towards 240 to 250 for the next 1 to 2 months time frame.
Okay. And some movers as well in trade today, Arpit. I wonder how you what you make of the moves on MRPL, Chennai Petro, these kinds of 7 to 10% kind of moves sustainable? Should you go long at these levels as well or hold off?
So definitely we have to see the trend of the stock. And firstly, if I look at the trend of the stock of MRPL, after a very long time, we have seen such a sharp up move. If I look at the bigger trend, the stock is still sideways with negative bias. So it's better to wait and let it be take a breather. Important is whether the next is we see a follow-up buying action or no. If there's no buying action, it's better to avoid because such counters generally they move for 1 to 2 days in a rapid move of 8 to 10%, and post that they are again in a corrective phase. So it's better to take a breather and take look at the sectors that are relatively outperforming and in continuously uptrend.
Okay, the other one which is absolutely flying in trade today is Mrs. Bector's. Now the stock soared in largely because Abacus has picked up a near 1% stake in the company. The company eyes a 14% EBITDA margin and low to mid-teen export growth. Staying here with all of the details.
That's right. A stock to watch out for in trade today has been Mrs. Bector's Food on the back of Sunil Singhania's fund Abacus buying about 1% stakes. To be precise, it's a 0.95% stake that the fund has picked up. Translated to shares, that's up to 29.3 lakh shares. The deal has been done at a price of 168.97 rupees per share, which was the stock's closing price in yesterday's trade. Just to understand a little bit more about the shareholding patterns of Mrs. Bector's Food, promoters hold up to 49%, FIIs hold 10.5%. DIIs are heavy on this name with 25.2% shareholding coming in from DIIs and 15.35% shareholding is open to the public. Now, in terms of some significant DII holding worth knowing about, Canara Robeco Mutual Fund holds 4.5% stake, Axis Mutual Fund, SBI Multicap Fund, Aditya Birla Sun Life and Invesco India, all of them hold stake in this company anywhere between 2.5% and 4% each. So that's the shape, that's the kind of picture that you have from the DII holding when it comes to Mrs. Bector's Food. Trying to understand what their FY27 guidance is. Remember, the company is coming out of a little bit of a slump because in the previous 2 quarters, the GSE transition was there. You had raw material packaging, raw material prices that had spiked up, packaging prices that have gone up on account of the war. Although Q4 was a good quarter for the company, all eyes are going to be now on whether that momentum can be sustainable into Q1 and the rest of FY27. Quickly, just taking you through what their guidance is: low to mid-teens growth in the biscuit segment for FY27, mid-teens growth in the bakery segment. They aim to get closer to 14% EBITDA margins with sequential recovery and sequential improvement. Low to mid-teen export growth is something that they're eyeing, but they've also flagged off a 3% impact on the top line on account of the raw material inflation that we've seen for crude, palm oil, as well as packaging costs and the wage hikes that the company has undertaken. So we're going to be watching out for the earnings later this month. Revenue is expected to go up by 13%. We're expected to see a 20% growth in PAT and a 30 bips expansion in margin. On the back of all of these triggers, you've got brokerages that are bullish on the stock. Investec, Motilal Oswal, Anand Rathi and Elara Capital have all maintained their buy rating on the stock. So that's the roundup on Mrs. Bector's Food and trade today.
Thank you for that, Snehi. Let me also bring on board Ambrish Baliga of he's independent market analyst rather. And Ambrish, what do you make of this this buy into Mrs. Bector's, and is there a view that you have with regard to QSR in general as well?
No, in fact, I'm positive on Mrs. Bector's, and the last 2 quarters, 2 to 3 quarters were a bit difficult. I mean, we've had the GST transition, we had the logistics costs, moving up, the raw material costs going up, labor costs going up, and that could not be passed on. But going ahead, clearly, that has already started happening. And at the same time, they're also improving their footprint across India. It was more of north-based. They are increasing their footprint. So that also should be positive. And at the same time, the stock also has underperformed recently, quite a lot. So even at these levels, I would suggest a buy, although we have seen a 10% sort of a move today. In fact, I have a price target of about 240 to 260 over the next 6 to 8 months.
Wow, okay, so that's quite a bit of upside. Arpit, your view on this one?
Just looking at the monthly setup, and if we look at the setup, so the stock was in totally downtrend for last almost couple of months. But today, if we see interestingly on the weekly time frame, strong bullish candle has been formed. We have seen RSI divergence after almost in last 3 to 4 months. So definitely the stock has come out of its short-term moving averages. But looking at the setup wise, 200 is the level to watch out for. One, the stock closes about 200 above. Definitely the short-term bottom would be placed for a bounce towards 230 to 250 levels. So from an immediate perspective, to play from a bounce back move, it is at major support zone. So one can see a move towards first 200, and once it closes above 200, we can see a move towards 230 to 240 levels with major support around 160 zones.
Okay. That's the take with regard to Mrs. Bector's. What we'll do is slip in a very short break, come back for more. Stay with us.
Back with closing trades right here, Nifty. Now, just monitoring what the closing trades are looking like, and we've settled in okay. While we didn't quite latch on to the high of the day, remember earlier this morning we were also holding up by over 100 points. Eternal is the one which is under pressure right now. You've got an HDFC Bank as well, lower by about 7/10. And then the likes of L&T, Shriram, etc. as well are seeing a tad bit of weakness, along with BEL and SBI Life as well. Having said that, lots of winners, as is the case with losers as well, within the broader end of the market, which, by the way, the breadth is favoring the declines as we speak right now. HDFC, AMC, Nuvama, NAM India, ICICI Lombard, these are all the stocks which are cracking. But on the flip side, ABB, after its commentary on the India division, Dixon, of course, is a clear winner from the word go today. UPL is holding up 5% as we speak right now. IEX is up 4.5%. And then SRF as well, which is seeing a good buzz today. It's holding up nearly 3.7% as we speak. Arpit, just wanted to understand, how is it that you propose one trades or goes about the entire EMS play now? Dixon, along with Kane, of course, has seen a very big move. But do you think they are still, do they still merit a buy?
So definitely, if you have seen, we have to see the relative strength of the counter and the technical setup of these from a positional perspective. So if I look at overall the theme-wise, Dixon relatively still is an outperformer. So if I see the monthly setup, after a sharp corrective move from 18,000 to almost 10,000 levels, we have seen a very sharp bounce back move from lower levels in Dixon towards 40,000 plus levels. So if we look at the monthly setup, the setup is still strong. The structure of higher highs, higher lows is intact on the quarterly chart. So our sense is that Dixon can again reclaim towards 15,500, 16,000 plus levels positionally. However, if we see overall the structure of Keynes, so Keynes has been relatively an underperformer, and in spite of broader market momentum, the stock is still underperforming. So our sense is that within a choice between Dixon and Keynes Technology, Dixon would be a preferred pick. Very strong setup on the monthly time frame. So we'd like to go with Dixon for a new life high, for a previous target towards 15,500, 16,000, and then positionally to its previous lifetime high around 18,000 plus levels.
Right. Okay. That's the take right now on the overall market. But great to have you on the show, Arpit. Thanks as always for your time. Let me also welcome on board Ajit Nayak from HDFC Securities. Ajit, hi, afternoon. Just looking at the market construct right now. Firstly, your take on the index, because it's been a little choppy today.
Tension. Yes, if we look at the index, so what index is probably doing is doing nothing. It's just trading between the range of 24,000. 250 odd level, and the lower side support comes to around 23,980 level. So in the midst of the news and all geopolitical issue, Nifty is just being trading into sideways markets. If you also look at the India VIX, which is around 12.8, so that is also comparatively very low. So low VIX is really healthy for the market, but we are not able to witness any trending situation right now, because if you look at the market from a open interest perspective, the option distribution data, the call writers and put writers are heavily build up their position near 24,200 and 23,900 odd level. So we need a decisive break of either side. So looking at the chart, I feel that chart is little weak, except mid cap and small caps, they are doing fantastically well. There are a lot of liquidity over there. There is a good bull run we can see in many of the stocks. But index specific, Bank Nifty and Nifty, they are still under pressure. We need a decisive break above 24,350, just to say that we are not in a false breakout. So that is why I've kept a gap of 100 points. So once we close above that level, then we can see a good up move.
Okay. What do you make of the move in the Nifty Bank and the IT index, if you can give us a sense?
First, I would like to speak about the IT index. So IT index on a last week time frame, if we look at the IT index, so there was a bullish hammer formation which has happened, and the concurrent candle also gave a confirmation. So I think IT index, there is a lot of scope for the upside. I think if you look at the IT index from a monthly and a weekly perspective, I still see IT index has a potential to go a long way, maybe probably a 10 to 15% from the current level. Even a few IT stocks have delivering the good results, so that will also corroborate and support the current IT view which we are building upon. So IT index is looking great. But when the IT index moves, that builds a lot of pressure on the banking index as well. That is what we have seen from last couple of session. Banking has taken a halt and it's not moving either way. So for banking index to move, it should go above 58,400 odd level. If we see such kind of conviction breakout on banking space, then definitely banking would also participate in the rally. But as of now, I feel that is also in a sideways kind of a situation where it is hovering between 58,400 to 56,900 odd level.
Okay, and I'll just quickly switch focus onto an ET Now exclusive. ITC's executive director and the CEO of ITC Foods, Hemant Malik, remains optimistic about the industry's growth roadmap. The food industry is experiencing no pressure due to geopolitical crisis or El Nino, and he in fact adds that India remains a market with huge potential. Listen in.
So I think first of all, I would not say we have had any supply disruptions. Supplies have been made available. My team has been resilient and very agile in making sure that, the supplies is not a challenge. Having said that, there are times when the prices may have gone up. So yes, if the prices have gone up, so that is something, how you manage those price increase in your entire P&L, and therefore you look at other efficiencies that you can bring in, productivity increases. And finally, you might have to pass on some increase relative, because you also have to look at the market, you have to look at the consumer's ability to actually pay a higher cost, and therefore you have to balance all these things, and you take it forward from there.
So, as we know that due to this crisis, the inflation is going up. I mean, RBI has projected 5.1% for the entire year. So, how this has been impacting the consumption pattern, and what sorts of steps or plannings that you have been doing for that?
So, I think consumption has been pretty okay, pretty good, I would say, right? So, we haven't seen the kind of pressure right now. What can happen in the future is something for us to see. It is possible that, when I said supply disruption, yes, for larger companies that may not have been an issue, but for smaller organizations, that supply was a constraint, right? So I was talking more from larger organization perspective, but when I look at the overall food companies, I know that small suppliers had an issue, and some of them might have stopped manufacture. And that would, obviously, the market demand is pretty robust right now, right? So therefore, that would have helped the larger manufacturers to that extent.
So India has been signing FTAs. I mean, yesterday only the FTA with UK has come into effect. So what kind of expectations you have with these FTAs?
So I think it's compliments to the government of India for working so aggressively with so much of effort to be able to sign a slew of FTAs across the world. And I know our ministers have been very busy and engaged with that. The UK FTA, you're right, has come into existence now. Soon we'll have something with the EU as well. I think from a food processing perspective, there used to be other kind of barriers, right? And I think through these FTAs, I'm hopeful that those will get addressed. Having said that, just by signing an FTA doesn't mean that you will be able to grow your business. We have to innovate. We have to make sure that we have the relevant products.
Okay, let's move on and let's talk about what, or rather where we're settling in for the market right now. Eternal, of course, is the one stock which is under pressure. It's down about almost 2.5% in trade right now. L&T is the other softer one. HDFC Bank down 0.7%. And BEL is also lower by about almost 1% as we speak. Technology, of course, is holding out okay. You've got HCL Technologies higher by about 2%. Wipro higher. You've got a TCS and Infosys as well, which are holding up well in trade right now. Interglobe Aviation as well is looking up by about almost 2%. And then Bajaj Finance, Maruti, M&M, these are your other heavyweights which are looking good as we speak. Amrish, wanted to understand where is it that you're now scouting for opportunities, if at all, within auto and auto anchs, although they've already run up quite a fair bit from March lows?
Auto ancillaries, the sort of numbers which are coming month on month, I think clearly shows that the growth is going to continue. And I would surely look at the auto ancillaries which are also export oriented. So basically, I'm looking across auto as well as auto ancillaries. And in auto, it would be more of the slightly larger EV players like Mahindra and Tata Motors PV. And in the two-wheelers, clearly looking at stocks like TVS, where I see the growth continuing. Auto ancillaries, it is across, like Motherson is the one which I'm quite comfortable with, even at these levels. And if you're talking of the other sectors, I would surely be positive on specialty chemicals, where we've started seeing a decent amount of movement in the last couple of months. And when you look at the earnings, they have been improving quarter on quarter.
Okay. Amrish, also keen to know some of these renewable energy plays, the likes of an MV, very strong numbers. Sustainable in your opinion? Any picks where risk reward looks decent?
No, this is sustainable at least in the foreseeable future, at least until about 2030. This growth would be sustainable because the government focuses there for a huge expansion in like renewable energy total capacity. So that's going to benefit all these companies. And I would take possibly a contrarian call on something like a SW Solar, Sterling and Wilson. Looking at the strong backing of a group like Reliance, although they've had issues in the past because of whatever deals they had done, but then I think that is clearly indemnified by the earlier promoters. And I see their performance improving at least quarter on quarter over the next 4 to 6 quarters. So at these levels, it makes sense buying into this as a contrarian call.
Well, Hiromoto, that's the one which is in focus right now. They've partnered with KSR Group, and that marks their entry into Germany. Avi, in fact, is here with more details on this partnership.
Corp has some news buzzing as they enter now Germany market with a distribution partner KSR Group. So Germany will be the fifth European market after Italy, Spain, France, and UK, and the 53rd country overall. They will be launching two Euro 5 compliant motorcycles, which is the Xpulse 200 4V and Xpulse 200 Pro, at a price of 299 euros, and the premium version coming in at 329 euros. The go-to-market strategy will be to establish 28 plus official sales and service centers with the target to reach 30 sales service center across Germany, backed by authorized dealership. And as an attempt to attract customers initially in the Germany market, they will be offering a 5-year warranty, as in it includes a 3-year standard warranty plus a 2-year warranty offer to attract customers on the launch of these two new vehicles by Hero MotoCorp in the Germany market. So that is a big news as Hero MotoCorp now enters Germany and expands its European presence.
Okay, thank you for that, Avi. Ajit, how do you look at some of the two-wheeler and four-wheeler names? Would you prefer those? Would you prefer the CV pack? How should one play it? What's looking good on charts?
If I look at the two-wheeler space, especially what we discussed now, let it be Bajaj Auto or a Hero MotoCorp, they are not looking that good on chart. Maybe from a chart perspective, I want Hero Motor to sustain above 5200. Then only we'll get a conviction that it has formed a solid base and we can expect some up move. But if you look at the overall auto space, though they look that we have seen a decent correction and look attractive by the numbers, on also technical front, we see that it is near to the fair value when it approaches to our moving averages, important moving averages. We feel that it is very good, but I don't see any strong bullish reversal pattern on major auto spaces. So I'm little reluctant to give my positive view on it. But definitely, once it crosses or give a bullish formation, then we would not be hesitant to issue or say that we are bullish on auto.
Okay, let me in fact go across to Darshita. Two companies, of course, which will come out with numbers at some point of time today. Tech Mahindra, steady quarter expected with a decline in dollar revenue. BFSI is expected to remain healthy while telecom could drive growth. Darshita here with what to expect.
Right, Tech Mahindra is set to announce its Q1 FY27 results, and the expectations are pointing towards a decent quarter with steady growth and continued margin improvement. So starting off first with financials, where the revenue is expected to come in at around 15,400 crore, which is up 2.5% sequentially, while in the dollar terms, the revenue is likely to decline about 2.1%, coming in at $1.61 billion, which is mainly due to the currency movements. Now, on the profitability side, the EBIT is expected to see a rise of 5%, coming in at around 2,200 crore, while the EBIT margins can see an improvement of 50 basis points sequentially, coming in at 14.1%. Profit after tax is also can also see the growth of about 17% QOQ, coming in at 1,500 crores. Now, operationally, the constant currency growth revenue is expected to come in the range of 1 to 1.2%, which is better than 0.6% reported in the previous quarter. And the deal wins are likely to remain healthy in the band of $900 million to $1 billion. Another key business segment is telecom, which is expected to lead the growth on the back of deal ramp-ups, while the BFSI segment should remain resilient. However, the high-tech business verticals could stay under pressure due to the cautious discretionary spending, while the manufacturing is expected to remain stable despite the weakness in the US auto market. Investors will now closely watch management commentary on the communication recovery, demand trends across the BFSI and the manufacturing segment, AI-led productivity benefits, and whether the company continues to maintain the 15% EBIT margin guidance for the financial year 27.
Okay, that's what to expect from Tech Mahindra right now. And IT really been one up day, one down day. And today seems like it's that green day. And you've got some of these names actually hold out in trade right now. The likes of HCL Technologies, Wipro, TechM, TCS, they're all looking good as we speak right now. Ajit, any trading opportunity, or would you wait it out for some of the big boy earnings to actually pass through before taking a more material or sustained call?
We can have some sort of preempted trades. Like if we look at the chart of Tech Mahindra, it is looking good on chart. So 1450 is a band where we are looking for a dip, and in that dip area we can take a low risk kind of a trade. Because if we compare any other IT stock, this Tech Mahindra is relatively outperforming other IT spaces. So I feel that this stock would be great opportunity to buy on dip. And the second one is a Coforge. If we compare the IT stock, the relative performance is much better than Tech Mahindra also. So any dip around 1440, that is a good support zone for Coforge. So it is again low risk, very low risk to reward, favorable point is a position where we can take a position over here.
Well, Wipro also is all set to report its numbers. Let me get Darshita back and tell us what the street is expecting from Wipro this time.
Right, Wipro is set to announce its Q1 FY27 results, and the expectation are pointing towards another subdued quarter for the IT major. Revenue in dollar terms is expected to come in at around $2.59 billion, which is down 2.2% sequentially, near the lower end of the company's guidance. In the rupee terms, however, revenue is likely to rise about 2%, coming in at 24,700 crores, which is largely aided by currency movements. Margins, however, are expected to remain under pressure. EBIT is estimated to come in at around 4,100 crores, while the net profit is expected at around 3,400 crores. EBIT margins is likely to decline by 65 basis points sequentially, coming in at 16.6%, reflecting the impact of wage hikes and continued investments into AI. Operationally, constant currency is expected to remain modest at around 1.3 to 1.5%. The BFSI vertical could stay weak due to client-specific issues and the delayed project ramp-up, while manufacturing and healthcare may also remain subdued. Now, the biggest focus, however, will be Wipro's guidance for the current quarter. The street is expecting the company to guide into -1 to +1% constant currency growth. And apart from the numbers, investors will closely track the management commentary on margins, large deal ramp-ups, conversion of deal wins into revenue, and the demand outlook. And those are the factors which are likely to determine the stock's next move.
Okay, that's the expectation from Wipro. But Amrish wanted to understand whether IT is still a valuation game, or are you still waiting to see growth before you actually make that call?
No, valuations have come, quite decent. But then we need to, get to understand as to why IT stocks have been underperforming. Basically because we seem to have missed the AI bandwagon, and even going ahead, we may not be really a competition as far as AI creators are concerned. But I see a huge opportunity. Building a bridge between the AI creators and AI users. I think that's where the Indian IT companies may fit in well. And there's, expertise in system integration, domain knowledge, and efficient last mile delivery. I think that's what will come into play. So in the longer run, I think IT companies will be able to pare down also their human costs as AI adoption accelerates, freeing up those locked up assets. And their current bread and butter business would anyway continue. Although the AI narrative, I think that seems to have clouded the sentiment right now. So an IT company, possibly 5 years down the line, possibly will be a very different animal than what we are seeing today. And leaders like TCS, I think, would need to transform themselves to stay, relevant. So going by the past track record, I think there's a high probability that we would have a new look in the next 4 or 5 years. Very difficult to say whether TCS will continue to be a leader or something like a Persistent could become a leader. So that's what we need to possibly wait and watch out for, and possibly pick up those which could possibly become tomorrow's leaders. And I see that happening more in the large mid-cap IT space. So I think over the next 1 or 2 quarters, we should get a decent idea and start buying into those for the next 4 or 5 years.
The other two stocks that I want to quickly mark out. One is, of course, BHEL. They came out with numbers, very strong set. Knowing that generally Q1 is softer, the strength of the numbers is evident. 40% growth on revenue. You have a 504 crore EBITDA versus a loss of 537 crore. EBITDA margins this time at 6.6%. If I factor other income, it's around 200 odd crore, which is a 25% growth. And you've got profitability also, which has surged 377 crore versus 456 crore loss same time last year. So some very, very different numbers coming in. Power revenue, that's what's really driving the top line. The growth is 52% on the power segment. How do you read the numbers, Amrish? This one is one. There's another one called JNA Axles. That one also very strong numbers. CV cycle likely turning a corner on a global front as well as domestically. And that's aiding some of these axle manufacturers. Both of those flying. Any views here, Amrish?
The first one is BHEL, isn't it?
Yes. Yes, please.
BHEL, the sort of order flows which are there, and earlier we had seen some execution issues, but that is not there any longer. And the sort of earnings they've been showing, I think we should see much, much better levels than what we have seen in the recent past. So BHEL, I'm quite positive on. We should be able to see levels of about 540, 550, possibly in the next 9 to 12 months. The other stock, in fact, I don't really track closely, so difficult to comment on that.
As a cycle, do you expect that to turn around, Amrish? Because, okay, let me quickly mark out the numbers for viewer context. 37% revenue growth on a YOY basis. EBITDA is up 39%. 15.3% margin versus 15.1 YOY. And profit has surged 65%. Operational efficiency also kicking in. Amrish, simple question. CV and some of the ancillaries could well benefit from this cycle, or you believe that this could be a one-off, maybe a 1 or 2 quarter thing, which could then reverse?
No, I see this growth continuing at least for the next few quarters, not just next 1 or 2 quarters. And as far as auto ancillaries are concerned, I think the UK FTA also should benefit them, as well as the other FTAs which we are talking about. So overall, I think ancillaries, that's one of the reasons I especially mentioned earlier also, that I'm looking at more of those ancillaries which have a decent export market.
Okay, that's that on the ancillaries. Today, of course, it's ABB, which is holding on once again. If we can just get in our researcher to highlight what the ABB India specifically commentary was. But this stock, of course, has shot up a good 6.6% as we speak right now, even though it's eased off just that tad bit from the top of the day, but still going very strong. And I think Snehi would have those details on what ABB's, India analysis and the kind of projection that they've made for their India business. And just from there, you've seen a very, very steady performance come in for ABB, still holding around that 76.68 odd level in trade. Ajit, let's get you to do a chart check for ABB, and if you're liking anything else within the cap goods space.
Yeah, so ABB is a very interesting chart pattern. It has developed a contracting kind of a triangle, and yesterday itself it has given a good breakout, and today we can see the traction. So I feel this stock has left some, more upside steam is left in the stock. So this stock can test around 8,888 level. But only concern is it is now near to the supply zone, which it has formed on the December 20th. So that is an interesting supply. So if we cross and close above today's whatever high it has made, probably around 7,950 odd level. If it is close, then I think good upside momentum is left. This stock has a potential to go next 20 to 25% if we look on a monthly and weekly time frame. So very interesting chart pattern has developed on ABB. After a contracting triangle, we see a good uptrend resumes, and lot of potential is there in this stock.
Okay, that's the take coming in on ABB right now, still going strong. In fact, Snehi is here to tell us what ABB's commentary was specifically to its India business, which really cheered the street today.
Well, absolutely. This cheer that we're seeing in ABB India stock is on the back of the very strong set of numbers that have been reported by its global parent, ABB Global, for their second quarter. The revenue saw an uptick of 14%. Operational EBITDA was up 20% on a year-on-year basis. The order book is the highest ever for the global parent, at least in the last 2.5 years. It's come in at $12,042 million. That is an uptick of 30% on a year-on-year basis. The cash flow from operating activities has grown 9% year-on-year, and free cash flow has come in at $828 million, which is an addition of $36 million on a year-on-year basis. Just taking a look at what the geography breakup is and why India plays a very important role over here. First, for the Americas, the growth over there has been 52%, for Europe 12%, for Asia and Middle East, along with Australia, that growth is up 12% for the AMEA market. Within AMEA, what really shines out bright is India, because the growth over here in terms of the order book size for India is up 81% on a year-on-year basis, and this is a number that we've not seen before. For China, the growth is a tepid 10%, and in fact for South Korea there's a degrowth of 8%. So you can see the kind of outperformance that the India segment within the global parent has shown for itself when it comes to the order book strength. In terms of some other major announcements that are keeping ABB excited, it's because ABB Global has announced an acquisition of Rotork PLC for an all-cash deal of $5.5 billion. So that is also something that is positive. And lastly, in terms of outlook by the global parent, they have said that they're on track towards improving their prior year's annual free cash flow of $4.6 billion. Remember, already so far this year, we're halfway down the road and $2.1 billion have already been logged in over here. Low to mid-teens growth on a year-on-year basis for revenue on a comparable basis is for quarter 3 is what they've guided. They've guided for the operational EBITDA margin to show sequential improvement, and FY26 comparable revenue will see low double-digit to low teens growth is something that they have said. So the outlook by the global parent is quite strong. India's role in the global parent's numbers has also been quite substantial. Order book shining bright for India with a growth of 81%, and that's the reason why, because of the global parents' very strong earnings, the ABB India stock is in focus today.
Thank you for that, Snehi. That's with regard to ABB India. Ambrish, very quickly, any view with regard to ABB?
I mean, the stock has done extremely well, Shirley. I mean, like that's reflecting the performance in the recent past. But at the current levels, I'm finding the valuations a bit stretched. So I will not possibly sell if it's there in the portfolio, but I'll not buy fresh at this point of time.
Okay, that's the day coming in on ABB. Let's get set to close for the day. Ambrish, great to have you on the show as always. We'll let you go.